This is Nightly Business Report with Tyler Matheson and Susie Garrett. Funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
Crude correction. Oil falls more than 10% this week alone. It now sits at its lowest level in nearly 6 years.
Stock slide. The Dow drops more than 300 points thanks to that cratering crude. The industrial average having its worst week in more than 3 years.
The bright side. This week's Market Monitor says the plunge in oil is a gift for investors. He says he's got some packages you should unwrap. All that and more for this Friday, December 12th.
Good evening, everyone. A dramatic sell-off in stocks today with the Dow tumbling more than 300 points. The sell-off snapped a streak of 7 winning weeks in a row for the markets. We'll have more on that in just a moment. But we begin tonight with the price of oil, which also fell today and fell hard to a nearly 6-year low. The latest driver, the International Energy Agency, is now predicting that global oil demand next year will grow even less than first predicted, renewing investor worries about slowing economic growth around the globe. Here's how oil prices settled today. Domestic crude tumbled more than $2 to $57.81 a barrel, down 12% just this week. International Brent crude was off $1.83 to $61.85 a barrel. That's a drop of 11% for the week. Jackie DeAngelis has more on the latest plunge in oil and just how low oil prices could really go.
Is $50 a barrel the new $100 a barrel for crude? Traders seem to think so, and that sentiment is reflected in crude's price action. Crude oil down more than 10% this week alone, and even under $60, the market is forecasting more downside.
Unless you see something happen geopolitically to make this market go higher, unless you see anything happen in terms of technicals for it to do some sort of turnaround on a daily chart, I don't really see it going back up right now.
Great news for consumers. With crude and gasoline down more than 40% this year, the national average for a gallon of gas now $2.60, according to AAA, and experts are calling for $2.50 by the end of the year. But there's been a mixed reaction in the stock market. Big energy producers have seen their share prices drop, and that's making investors change their investment strategy for 2015. The focus now on rail. Rail shipments of crude have gone from just 20,000 barrels a day in 2009 to an expected 1.1 million barrels this year. And since pipeline capacity can't keep up with production, rail is expected to continue to fill the gap.
We are seeing an increase in rail shipments, principally due to the growth of North American supply. It has occurred at such a pace that the existing pipeline transportation infrastructure has struggled to keep up. It
seems to be the perfect storm for rail. Record shipments at a time when low oil prices mean costs come down. The stocks to watch: Kansas City Southern, Norfolk Southern, Union Pacific, and CSX, to name a few. While ExxonMobil and Chevron are down 13% and 17% year to date, the rails are seeing double-digit gains on the year. For Nightly Business Report, I'm Jackie DeAngelis.
And now back to that big sell-off in stocks today, which accelerated into the closing bell, wiping out all the gains that you've made since October and capping off the worst week for the Dow in more than 3 years. Here's how things looked at the close, and close your eyes, it was ugly. The Dow down a bracing 315 points, the NASDAQ off 54, and the S&P ended lower by 33. For the week, send the children out of the room for this. The Dow and the S&P were both down about 3.5%. The NASDAQ fared a little bit better. It was down 2 2/3%.
Joining us now for more analysis on the sell-off in oil and other commodities, John Kilduff, he's founding partner of Again Capital, and Daniel Rohr, he's director of materials research at Morningstar. John, let me begin with you here. You heard in the report that some people are predicting $50 a barrel oil. Some people I've seen are calling for $40. First of all, do you think it could get that low? And if it does, is that good or bad for the global economy?
Well, I think it can. I think 50, what Jackie DeAngelis was referring to, is sort of a big fat round number, psychological level that people are going to key on. Even casual observers of this market will now be honing in on to see if we break that level next week, which it could come that quickly. And yes, I do believe it could happen. The reason is this is commodities. The whole syndrome that we're in right now is increased supply, shaky demand, and nothing's being done to address either end of that spectrum. We're not seeing a pickup in the global economies, and nobody, and I mean nobody, is doing anything to cut back on supply to this market.
And in fact, John, 2 weeks ago when you were here, right the day before Thanksgiving, oil was about 70, and you saw it going into the 50s early in 2015, but I guess we've gotten there a little ahead of your schedule. But let the record show that Kilduff was right, as he so often is. Daniel Rohr, welcome. Good to have you with us. One of the sort of stealth bear markets has been in a whole realm of other commodities, the hard goods like copper, iron ore, and so forth. If they got the kind of coverage equities get on this program and elsewhere, we'd be really rolling, wouldn't we, Daniel?
You certainly would. You take a look at something like iron ore, started the year at 135. We're now below $70 a ton on that stuff. And what that's really giving you is a pulse of the Chinese economy, specifically the pulse of the Chinese real estate market. And that market is teetering right now.
All right, so are we talking, Daniel, of I hate to use this word because it gets misunderstood, of a crash of sorts that's going on in the commodities market? And what's the ripple effect of that?
Well, comparing where we are today in prices versus long-term prices, we're still well above where we had been historically. So we're still well above historical norms. As far as whether we could be looking at further declines heading into 2015, and this would perhaps meet the definition of crash then, we think there's certainly more downside risk to the market, to the extent we believe there's more downside risk to Chinese fixed asset investment, in particularly real estate.
You know, John, you look most especially at the physical commodity itself. But as you have been here a couple of times, you've talked about some of the companies that are highly leveraged in the oil shale boom that might be vulnerable. But I've got to think that at some point, the prices of some of the oil company stocks, and I don't want to get you out beyond your swimming depth here, have got to start to look a little bit attractive because they've been hurt so badly.
I think so. And it will certainly be, again, this is commodities. At some point, there will be a supply response, whether it's from OPEC or whether a lot of these companies get squeezed out because they're forced to go bankrupt or have to halt operations for other things. So yes,
some
absolutely.
Supply will go offline.
There's no question about it. It's going to get squeezed off. It's uneconomical. Their debt levels, their debt is unsustainable. So there will be casualties. And so, yes, the supply will contract. This should be stimulative to the global economy, to most of the consuming Europeans, the Chinese as well.
Europeans have got a lot of this.
It could add a full % of GDP to Spain, we're projecting, just as an example. So, but to your point, I would still caution people, this could still get very ugly, $40, $35 a barrel. So, and you don't know where the casualties are going to come from and how much contagion is there. So it's better in this sector. Wait till you see the whites of the turnaround, of the eyes of the turnaround, before you get in this thing. But then get in early. But it'll be pretty clear that things are turning around, and that's when you can buy.
We'll have you there. We'll have you there to tell us, okay?
Then, but yes.
Let's talk a little bit more about how we got to this situation. I mean, what's really going on? Dan just mentioned a moment ago demand in China. We always hear this. Economy in China is slowing down. Emerging markets is slowing down. Is that all that it is? Because we see in the U.S. things are picking up.
Well, this time around, in the past, the sell-offs for gasoline and crude oil were because of slowing economic conditions around the world. Here we do have some slowness in China, but the United States stepped up like a heavyweight boxing champion here and just delivered oil to this market, to the U.S. Gulf Coast through fracking. You heard the story. We came in on this jump in rail shipments, from 20,000 to over 1 million barrels a day. I mean, this is crazy stuff. And we also rejiggered a lot of our internal pipelines to bring this oil to market. So it's just been an incredible turnaround that's done this.
Dan, we talked about the industrial commodities. We didn't really hit on gold. What's your view of gold at its current price and what may be next for it? I got to imagine that a fair number of our viewers right now own gold one way or another.
Yeah, gold's always an unusual animal to the extent it doesn't respond to the same supply and demand considerations that most commodities do. It's been funny that today, where we stand today on gold at about $12.25 an ounce, we're pretty much where we started the year. And we think some of that price stickiness around gold at $12.25 has to do with how much supply is being dug out of the ground at precisely that sort of price range. So when we look into 2015, we think current prices are actually a pretty good approximation of where they're likely to average for the year.
All right, Dan, thank you very much, gentlemen. John Kilduff from Again Capital here with us, and Daniel Rohr from Morningstar over in Chicago.
Well, falling oil prices may be rattling investors, but for the nation's package delivery companies, lower fuel costs mean plumper margins and bigger profits. As the biggest of them all, UPS, gears up for its busiest day of the year on the 22nd, Morgan Brennan went to the company's global sorting hub in Louisville, called the Worldport, to see how they're handling all that handling.
It's peak holiday season at UPS, and here at Worldport, that means all hands on deck.
This is our Super Bowl season. Everywhere, every day between Thanksgiving and all the way through the new year.
Worldport is the parcel carrier's global sorting hub that half of all express packages pass through. At this time of year, volume can triple, with almost 7,000 packages processed each second, moving along 155 miles of conveyor belts in a facility the size of 90 football fields.
Our aircraft numbers will change from 134 per day to upwards of 200, over 200 aircraft per day. Our volume levels itself will more than double.
To prevent a repeat of last year, when more than 1 million UPS packages missed their Christmas deadlines, the company has invested $675 million into its network and operations, updating facilities, adding more automation, increasing its workforce, and communicating more closely with customers. So far, it seems to be paying off. Shipping tracker ShipMatrix says the accuracy of on-time delivery rates during the week of Cyber Monday increased compared to last year.
FedEx has gone from 94 to 96, our data shows, and UPS has gone from 93 to 97. And that is a significant improvement when you consider that operating at that high level is a big challenge.
But Mother Nature is still the biggest wild card. That's why the parcel carriers have meteorologists on staff. Here at Worldport, UPS has 5. If poor weather moves in, they map alternative routes, and within a matter of minutes, a call can be made to divert a shipment, mobilizing reserve aircraft and de-icing crews.
For us, it's more important to be prepared for the worst case scenario than, so for instance, we actually put out alerts along the lines, okay, 30% risk of freezing drizzle in Kansas City or whatever, so that people are prepared for that possibility.
Many of these packages are moving in and out of this facility via airplane. UPS claims more than 500 planes in its air fleet, and competitor FedEx has a similarly large sum. So falling fuel costs could mean rising profits. It's the reason shares of both parcel carriers have recently hit all-time highs. But for that trend to continue, these packages need to get delivered by Christmas. And here at Worldport, the race is on. For Nightly Business Report, I'm Morgan Brennan in Louisville, Kentucky.
Congress delivered some good news late last night by averting another government shutdown. With just hours to go before a deadline, a deeply divided House narrowly passed a massive $1.1 trillion spending bill that'll keep the federal government up and running at least through next summer. Despite internal battles among Democrats about items in the bill, like a loosening up of bank regulations, President Obama supports its passage.
This, by definition, was a compromise bill. This is what's produced when you have the divided government that the American people voted for. There are a bunch of provisions in this bill that I really do not like.
Well, after approving a 2-day extension of current funding, the Senate debated the same bill today, and after it passes there, as expected, the president says he'll sign it into law.
And coming up, the stocks our market monitor says could make you money thanks to the big drop in oil and the prices of energy companies. But up next, the real-life drama playing out in Hollywood and the ripples being felt throughout Tinseltown. Privately held Hearst Corp., the media giant behind Good Housekeeping, Cosmo, and a host of other magazines, newspapers, local TV stations, upping its stake now in the credit agency Fitch Group. Who knew? as it looks to expand its data and financial information business. Hearst plans to pay nearly $2 billion for another 30% stake in Fitch, and that will bring its total share of the company to 80%.
Another big media company, Sony Pictures, is still reeling from last week's hack attack, which exposed a range of inside information on everything from executive pay to embarrassing internal emails. So how much could this real-life drama potentially cost the studio and some of those executives? Julia Borston has more.
On the heels of last night's premiere of The Interview about an assassination attempt on North Korea's Kim Jong-un, which sparked the hack attack, Sony is ramping up its defense. The studio's co-chairman Amy Pascal apologizing publicly for racially insensitive emails about President Obama. Her leaked emails with producer Scott Rudin reveal him calling Jolie a, quote, spoiled brat, just before Jolie and Pascal ran into each other.
It really is a disaster for the studio, and it's a wake-up call for corporate America.
These emails raising questions about whether Pascal will be pushed out. Pascal telling the Wrap, quote, I'd be surprised if my entire legacy was based on the leak of the email exchange. Meanwhile, the studio is working to stop the bleeding to disrupt downloads of sensitive data. Recode reporting that Sony's using hundreds of computers to execute a denial of service attack as the stakes and the costs continue to rise.
It's hard to estimate, but it's got to be in the, at least in the tens of millions of dollars. I mean, you have 5 films pirated, you have the cost of remediation, you have the probable, lawsuits from employees and ex-employees whose data and identities have been compromised. It just, and it goes on and on.
Now Hollywood players are turning to social media to respond to the private negative comments about them now shared with the world. Producer Megan Ellison responding to Scott Rudin's leaked emails, tweeting, bipolar 28-year-old lunatic? I always thought of myself more as eccentric. Kevin Hart responding to studio execs calling him a whore for seeking additional compensation with an Instagram post saying, quote, I refuse to be broken people. With that being said, it's now time for me to get back to building this empire I've always dreamed of. Shockwaves from the hack are rippling throughout Hollywood. Sources tell me across the industry, executives are shifting away from email and towards the phone. And they're searching through their emails with Sony executives to see if there's anything else that could potentially leak out, with some execs, even Amy Pascal, making calls to preemptively apologize. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Wow. All right, a Dow component says it will pay you more to own it, and that is where we begin tonight's market focus. It is General Electric, and it is raising its quarterly dividend 4.5%. It will now be 23 cents a share, and that brings the yield to 3.7%. Seventh dividend increase, by the way, in the last 5 years for General Electric, and shares of the company with the market today down by 52 cents to 24.89. Abbott Labs also going to up its dividend. The healthcare company will hike it by 2 cents to 24 cents a share. That's a 9% lift and pushes the stock's yield to more than 2%. Shares of the company fell nearly 2% to 43.69. Morgan Stanley moved lower today after Buckingham downgraded the stock to neutral from buy based on valuation. The firm says the stock now trades at a premium to its peer group. That's enough. Today, shares of Morgan fell 3%. For the year, it's down almost 16%.
Shares of Nu Skin fell today after saying it sees its 2015 profit below market expectations. This direct seller of skincare nutritional products cites a stronger dollar and regulatory concerns in China. Shares tumbled 6.5%, closing at $40.16. Two tech companies which help businesses analyze data had strong debuts on Wall Street today, New Relic and Hortonworks. Shares of New Relic shot up 48% on their first day of trading, closing at $33.99, while Yahoo spinoff Hortonworks jumped even higher, surging 65% to $26.38. They were 2 of 7 IPOs to hit the street today. And there may be some big changes in store at trucking giant Conway after the Teamsters won a vote to unionize drivers and dock workers at the company's Miami area facility. Shares of Conway fell 0.2% today to end at $47 and change.
Well, despite the big sell-off in oil and the drop in energy stocks, our market monitor tonight has energy picks. He says investors should buy now. Let's meet him. He's a guy whose name I can actually pronounce for a change. Hank Smith, Chief Investment Officer at Haverford Investments. Hank, welcome. Good to have you with us. And thanks for going easy with me with the name. You like some of the energy names here because you think they're at buy points?
Well, look, the broad market's up 200% off of the low, but in the last 2 months, the energy sector has sold off about 40%. And in our view, this is a buying opportunity for long-term investors, maybe not for traders. We might be early here, but particularly in the quality names, we think it represents a nice buying opportunity.
Well, let's talk about one of the big names in the oil space that we always think about, Hank, Exxon. It's trading now around $86. This was a $100 stock at the beginning of the year. I mean, do you have to have nerves of steel to buy it now?
No, I don't think so. I think this is one of the highest quality companies in the world. It has a history of not only paying a dividend, but increasing the dividend on a regular basis. It has a yield now over 3%. They're also buying back shares. You're buying it at a very low valuation. And more broadly speaking, Exxon has proven it can return positive returns to shareholders over the decades, regardless of where the price of oil has been. And so I think this is a good buying opportunity.
You point out that in the decade of the 2000s, Exxon, in a time when the oil was averaging 47 bucks a share, so 47 bucks a barrel, was returning 7% to investors. I'd take that any day.
7%. That's right. And remember, that was the decade of no returns for the broad market, and yet you got positive returns for Exxon. Even in the decade of the 70s, where oil averaged $10 a barrel, Exxon gave you positive returns. Make the
case for its Dow cousin Chevron.
Well, I think it's a very similar case, a very high quality. You're getting a better yield, 4+% yield. That is better than a bond yield. You can buy a U.S. Treasury for 2% today, or you can buy Chevron for twice that at a 4% yield and be relatively confident you're going to get growth of income there. Plus, Chevron actually has a little bit better production profile than Exxon right now.
And how about Schlumberger? That's the other one of your picks for today.
It is more volatile, but the highest quality within the service sector. It is down 30% off of its peak a few months ago, unlike Exxon and Chevron, which are down 15% and 20% respectively. But again, you are buying the highest quality company, and we think at 30% down from where it was a few months ago is a very good buy.
All right, thank you. Schlumberger is even more fun to say than Hank Smith. We appreciate it, Hank.
Right.
Enjoy it. Hank Smith with Haverford Investments.
And coming up next, how upstarts are taking aim at the snack aisle in your supermarket and a $16 billion business in the process. More fallout from those defective and potentially deadly airbags made by Japan's Takata Corporation, which could explode with too much force and spray shrapnel into the passenger area. Chrysler is expanding its current recall by another 200,000 cars and pickups in more high-humidity states, which now include Florida, Georgia, Hawaii, Louisiana, Mississippi, Texas, Puerto Rico, and the U.S. Virgin Islands.
And finally tonight, Susie, a look at how one upstart organic snack company is disrupting the grocery store snack aisle and getting a lot of people to eat just a little bit healthier. Jane Wells has more.
Well, I've been eating a lot of these lately.
And these are fighting for space on the snack table this football season.
The salty snacks business in the United States is almost $16 billion.
But potato chip sales have been struggling, and corn-based tortilla chips have been declared a gateway snack to obesity. So the guy who created Guiltless Gourmet in the 90s has come up with Bonitos, chips and puffs made from beans.
I like things that are high in protein.
Doug Foreman found no such snack, so he tried to make one on his own, something he didn't know beans about.
First of all, you know, you get everybody who says you can't do that, it'll never work, and you go through that stage. And then while you're trying to develop it, you're going, maybe those guys were right. You can't do it.
He did do it, though bean chips cost at least twice as much to produce as potato or tortilla chips. What about gassy after effects? Foreman claims Bonitos are not musical fruit due to the way they're made. And they're non-GMO, gluten-free, and everything else that's in right now. One of Foreman's investors has become CEO, Dan Costello, who used to work for Frito-Lay. And while Costello will not reveal sales numbers,
in the last 2.5 years, we've gone from roughly 5,000 outlets to 30,000 outlets.
Including Whole Foods and Sprouts. But Bonitos are only in about half the nation's supermarkets. Grocers aren't sure whether to put them in the snack aisle or with the healthy gluten-free foods.
It's not an easy thing to build a market where people, haven't seen the product before. So we have to make believers out of people.
Convincing Americans that snacking can be healthy and paying more to do so is the ultimate goal, especially during football season.
Super Bowl ad?
Not yet. It's been discussed, and I'll leave it at that.
Stay tuned. For Nightly Business Report, Jane Wells, Los Angeles.
So we have a weekend to have snack foods and to rethink what's going on with the markets and what you're going to do with your portfolio.
2 more trading weeks really left in this year, and that is it. And all of the gains from October wiped away in just the past week or so. Next week is going to be very interesting, a Fed meeting to look forward to, or not, as the case may be. But the market will certainly be paying a lot of attention to that and continuing what's going on in oil.
And a lot of window dressing in those portfolios. So we could see more sell-offs, but maybe
interesting
we'll be
2 weeks
lucky.
ahead, folks.
Absolutely. Hope you continue to watch Nightly Business Report. That's it for us for tonight. I'm Susie Garup. Have a great weekend.
And thanks from me as well. I'm Tyler Matheson. We will see you back here on Monday. Get your shopping done.
Nightly Business Report has been funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
I'm Susie Garup with a Nightly Business Report news brief. Another big Wall Street sell-off today, snapping a streak of 7 winning weeks in a row for the Dow and the S&P. That's after oil prices plunged again today to under $58 a barrel, a nearly 6-year low. The latest driver, a new forecast that global oil demand next year will grow even less than first predicted. Here's how things looked at the closing bell, and it was ugly. The Dow tumbled 315 points, ending its worst week in more than 3 years. The Nasdaq fell 54. The S&P lost 33 points. A deeply divided House narrowly passed a $1 trillion government funding bill, which the Senate is also expected to approve. And Chrysler is expanding its recall of cars and trucks with potentially deadly airbags. Be sure to tune in to Nightly Business Report right here on your public television station.